Every Monday morning at 7:15 a.m. Pacific Time, in my live streams, I am fully revealing my proprietary safe wheel strategy for free. Using my 28 years experience, I've developed the safe wheel strategy to cancel out the risks associated with the normal wheel strategy. I also designed the system to only need my attention once a week on Mondays and on rare occasions Fridays. And this is what I call a level 5 strategy. Now what you see on the screen is the trader matrix. I developed this to make it easy to distinguish between trading levels. After taking over 50 online stock and options courses, I've found that I'm the only level 5 trader that is not using portfolio margin. Portfolio margin is used for large accounts over $100,000. Now, after 28 years, I've only found one edge in trading, and that is selling option premium. Level 5 trade systems are the only way to sell option premium efficiently and safely. For a better explanation of the 5 trading levels, see the link in the description for the video called The 5 Stages of a Trader. Okay, let's get started this morning. The first thing I want you guys to do is post any questions that you might have. That way, when we get towards the end of the live stream, I'll have a chance to answer all the questions, because sometimes they kind of come in at the last second, and I want to be able to answer all the questions. The other thing is, I only trade level 5 trade systems, and if anyone does not understand what I mean by level 5, please ask a question in the comments. All right, let's take a look at my earnings edge. What happened last week? Well, the account was up to $6,000, so I decided I was going to size up, a little more than, with a $5,000 account. Of course, maybe there's an unwritten rule that every time you size up, you take a loss. So took a loss here, tried to make $400, lost $400. So the account's at 5,523. So I had 7 wins in a row, and now I've got 1 loss in a row. So 7 wins, 1 loss. That is kind of in line with my expectations. I expect to win 3 out of every 4 trades, and that would be very profitable if I do, which I've been doing lately. This particular account is up over 10% in just 3 months. And it does have a lot of volatility, so expect some volatility. And, this is only $259 a month, which you'll get way more. You should get way more value for that. In other words, you should make more money than that. I expect to make more money than that every month. Okay. Next, let's get into the safe wheel. That would be this account here. What is going on with the safe wheel? We can see that I own 100 shares and I have my put hedge on. Now, this is getting a little bit into the details. Last Friday, Macy's took a nice jump. Actually, over the whole last week, it went up significantly. And I had that 27.50 long call that I only bought for $5. And so I set my alarm to go in at like 5 or 10 minutes before the market closed on Friday, just to double check it. And it was up about $15. So I sold it, I made like $15 or $10 off of it. So I sold that out. And now I'm left with this position here where I'm long. So if you look at the matrix, at the flow chart, and I do have that flow chart for sale, by the way, and it's at a special price right now. But we are on our second tier. We added a second tier. And that particular put that we sold, that thing went away. It was worthless. And so I was left with my 100 shares and my put hedge. And basically, I'm looking at the flow chart here. Now, if the stock is up, which it is, then I would say, can I sell a covered call above this covered call right here? Can I sell it? So these are the questions in the flow chart. Can I sell this covered call? I bought it at 26.50. So can I get better than 1%? And the answer is yes, I can. And so if you go down the flow chart, is the position profitable? And the answer is yes. The overall position that I've been trading this particular cycle is profitable. So I should sell out the whole position. And so that the answer is to sell out the whole position right now and start over. So that's what I should do. So let's say that I did do that. And let's take a look at my put hedge. Let's just talk about the put hedge. Let's just say that I sold everything out and I started over. The put hedge with Macy's selling at $27 times 80%, what I would buy the $21 put. Well, I already own that $21 put, and you want to be 150 to 200 days. This one has 151 days. So I already own the put hedge that I need if I were to start this position over again. So I'm not going to trade out of that. And I hope that makes sense. But I am going to trade out of my 100 shares. I'm going to take my profit on the 100 shares, and I'm going to start to position over, even though I already have my my put. So that's what I'm going to do. So I'm going to create closing order. I'm trying to get maybe a little bit more. And you guys probably will have some questions about what I'm doing today and why I'm doing it. And that's good. Please put your questions in there. Okay. Chasing a little bit. All right. So now I'm starting over. I've made profit on the overall position or the overall cycle, and I'm going to start a new cycle. I already have my put hedge in. So all I need to do now is sell a put, sorry, and then buy a long call to protect that hedge. So which put? So I'm going to go into this particular expiration cycle, the one that expires on Friday. I'm going to sell a put. And I want to get at least 1%. So this $26 put, if it's greater than $26, 26 cents, then that's good. This $25.50, it's not greater than 25, so that's not, there's not enough premium in that one. So I could sell the $26.50, the $26. So I'm going to go ahead and sell the $26 put. I'm going to do one of those because I'm dealing with about a $5,000 account. So mid price 33. I'm going to try for 34. Just kind of put it in there. Okay, so we got 34. Okay, so now we have our put. Now we want to hedge this hedge, right? So in order to do that, I always buy a long call, usually around $5 or $6. There's a $30 right here. I'll buy this one. $6. Try to get 5. Okay, so I got it for 5. Okay. Let's see. Now we have our position on. Someone always asks me to look at the Analyze tab, so you can look at it. You can see that we have some upside risk up here. Make sure I've got everything checked. Yeah. So there is some upside risk right now, a little bit. But you can see, $100, but we're up, close to 500, so it's not major risk. Okay, so now that I've placed all the trades, let me get to the comments. All right, so one Curran says he loves selling option premium, and then he asks, what is level 5? So level 1 is, these are the levels that I went through, and I think a lot of people go through in trading. And level 1 is when I used fundamental analysis and I was just buying and selling stocks. Level 2 was when I used technical analysis when I was dealing with stocks. And number 3 was when I started buying options because I learned about leverage. And then number 4 is when I realized I need to sell option premium because there's an edge. But the problem with number 4 is what everybody else is. Anybody else that you see out there that's selling premium, that's out there on YouTube, they're all level 4 traders. And what that means is that they're not hedged properly, and their system can blow up on them. They can incur serious large losses. Level 5 is the level that we're trading, which is we're selling premium, but we're also hedged. That's level 5. Next question here. Will this work with ETFs that are liquid like SPY or index options? Yes, it will. And the thing is, though, I like to use a stock that's around $30 because then I can size everything properly. And I can size it based on a $5,000 account. I can do one tranche or one contract. And so that's the reason why I'm using it. Also, if you use a more volatile stock, it tends to work pretty good. You've got more premium to deal with. Sometimes you'll get a ETF or something that might not have enough premium in it. How do I know how much premium? Well, can I sell something that's not at the money, something that's out of the money, and still pick up that 1%? That means I have enough premium. When putting on a covered call after being assigned, do you also still add the $5 long call? Yes, I do, because the $5 long call is for my hedge, to protect the hedge. It's not to protect really anything else. So the fact is I always have that hedge on, and so it always needs protection. So the answer is yes. Please show the Analyze tab. There it is. Currently down 225 on my put hedge on first cycle. Wow, I don't think I was down that far. I'm not down that much on that put hedge. Let me take a look at it. And also, I've been selling premium around, I don't know if I sold $225 worth of premium. Here's my put hedge. Where are we here? I'm down $40 on it. So I'm not sure how that your put hedge worked out there. But I'm only down $40 on my put hedge. So make sure you get this flow chart, because you might have had a situation where it was time for you to get out of the complete position and start over. And maybe that's what happened. When you ask, is the position profitable? Yeah, it's not clear what you mean. That's true. It's difficult to tell because you've had a lot of past positions included in this particular cycle. And so I'm taking all the premium that I'd sold in this cycle, and I'm also looking at my current position, whatever it was at the time. I think my current position was even up without all the past, the last couple of weeks or few weeks of premium that I sold. I was still ahead in that position, even without that. So it was easy to determine. That can be a little bit difficult to determine. You have to kind of keep track of that. Does that level 5 hedging bring returns down a lot? Yes, it does bring your returns down. So you are not, like, if you're going to run the regular traditional wheel, the old school wheel, then you're going to see some nice profits. I mean, you're going to make 30, 40, 50, 60% a year, 100%, until you have that one blow up and then your whole account is blown out. Yes. So the answer to your question is yes. How far to the money is preferred when searching for the 1%? At least 50 cents out of them. When we're dealing with what we have here with Macy's, we're at least 50 cents out of the money. Anything out of the money, at least. If you can get that 1%, then you're good. I have the 19, so I'm assuming you're talking about the put hedge. So you must have got into Macy's when it dropped significantly, and you bought your put hedge at that point, and you probably did not get assigned. So yeah, I mean, your particular cycle might not be profitable, and that's happened. That happens. Fortunately for me, so far, every cycle that I've ran has been profitable, but not every cycle you run is going to be profitable. So you might have to, just follow the rules, get out, take a loss, get into the next cycle. But overall, when you look at all the back tests, you're going to be doing around 10% a year. That's based on the back test. In an ideal world, wouldn't it be better to enter the short put plus long call as a package? Yeah, I could probably do that. I like to break it down just to make it digestible for people or easier to understand. So I break it down into pieces. Okay, next question. What defines a cycle? The put hedge? Yeah, I guess if you go by the put hedge, that's a good way. I didn't think about it that way, but whenever you get out of a put hedge and put a new one on, that's pretty much when your cycle has been completed. Same here on Twitter. The protective call did not compensate for the put hedge. Twitter went up, causing a loss. The Analyze tab did not show any opportunity for profit on the upside. Okay, so you went with Twitter. That's interesting. That's pretty volatile stock. I haven't really back tested a real volatile stock like that one. And could have Twitter could have also went down, and you would have been into a lot of profit too. So just start another cycle. What's Twitter trading right now? 36.90. So yeah, because as long as you're under 40 and over 20, you can trade that particular stock and size it the way that I'm sizing it. Yeah. So it's better to ask, is this cycle profitable? Yeah, I mean, I look at the whole trade. It's kind of like each cycle is a trade. So if you're day trading, right, you look at a stock and, how did I do with that particular trade? I kind of look at the cycle as a trade. Paper trading, yeah, good. For me personally, I think paper trading is great, and a lot of people are good at that. I don't like paper trading because I'm just not into it enough. If the real money is not on the line, I'd prefer to just trade super, super small rather than day trading. But that's fine. Day trading is good too. At a $100,000 account, what kind of returns can be expected? Like I said, around 10% was what my back tests come out to be. I know you don't like technicals, but would be using technicals enhance your system. If I believed in technicals and they worked, of course I would. But the fact is, I don't believe that you can pick a direction and be profitable around it, even using this system. And we're not really directionally dependent, anyways, overall. So I would say, no, I'm not a technical guide. I don't think it would help. And that's what I'm doing. Paper trading, that's great. Paper trading is good because you can learn. You can learn that. Um, Okay, well, just don't forget that we have the safe wheel guidelines available. They're at a discount right now. I'm not sure how long I'm going to leave them down at that discount level. Um, of course, we have my earnings edge alerts for $259 a month. Remind you about that. And the returns so far this year um, on the safe wheel, we're up about 10%. And on the earnings edge, we're up about 10% also so far, and this has only been what, not even 3 months. So we're doing pretty well. I expect that safe wheel to do much better, but we'll see how that goes. I'm sorry, I expect the earnings edge to do much better. The safe wheel is doing really well, and it's not exceeding my expectations in any way. But the earnings edge is, I believe, is going to do much better. But again, you get more volatility, so don't forget about that. Okay, another question. Why not two long puts? Make it closer to the money. Yeah, because they'll lose value faster. And so what we're doing is we're selling the near term premium to make up for the long term premium loss. And so we don't want to have that long term premium outweigh the short term premium that we're selling. Okay, question. But you said 10% per year, so that's amazing. Yeah, absolutely. We are doing much better than expected with the safe wheel. Do you use only Macy's? No, I've used like EEM in my back tests, and I'll use different stocks. It just so happens that Macy's is around $30 right now, and it's staying around $30. So I keep using it over and over again. I could have changed today, actually. I could have changed my stock if I wanted to. Today would have been the day to do it. But I already had that put hedge on. It was already there. Why move in and out of that? What's another stock besides M? Like I said, I did EEM, and then Twitter might be okay too. Twitter might work. Something around $30. That's kind of the main criteria, but also it has to be very liquid. So if you look at see how these are liquid, 5 and 6, 25 cents, 27 cents, 82 and 88. These are very liquid. So that's the second criteria, not just around $30, but very liquid options. So as far as looking up another stock right now, I'd have to look around, but Twitter would look good. Let me look at Twitter real quick. See that $9, 9 and 10, 29 and 31, 60 and 63. Yeah, this is good. Twitter, it's got good liquidity. Not a lot of difference between the bid-ask spread. Probably not quite as liquid as Macy's though. Okay, here's another question. With larger ULs, does the 3-to-1 ratio on long puts and short puts could work? So Facebook, I got out of a bad trade on the upside, but the put hedge decayed too fast. I'm not sure what you're asking. Let's see. When you start using these acronyms, I get a little bit confused. But the 3-1 ratio on the long puts and short puts could work. Yeah, I mean, it should work. Like I said, I've done back tests, and a 3-to-1 ratio is what I've been using, and it's working well. If you had to put on a new hedge, did you say you would have chosen those exact puts? Yeah, it was close enough. I mean, it was 80% of $27 was around 21 to 22, and since I already had the $21 put hedge on, I don't want to. Why am I going to roll that to the 22? I mean, it's just going to cost me in transaction costs and slippage and everything, and I've already got it on. So the long protective call didn't cover the loss. No, but I was also long 100 shares that I didn't sell a call on. So you have to remember, because I don't remember who it was, but somebody was saying, well, why not take the 15 cents or 10 cents on the call that you have and write a covered call? Well, there's the example why. So not only did I have the protective call, but I also had those 100 shares. So I was able to mitigate any of the losses that I would have took on that put hedge. And you were mentioning underlying. So if I didn't answer your question, go ahead and put it in here again. What backtesting software do I use? I use OptionNet Explorer, and I have a 10% discount on that. If you're interested, you can just put a comment in this video later, and I'll respond to the comment with a link. Okay, of the long put. So you're referring to something else. Let's see. The long protector. I'm not sure what you're referring to. The call didn't cover the long put. You're continuing a conversation, which not sure which one you're continuing it on. Okay. Would it make sense to set these up on Fridays for the following Friday? There's a benefit of not being exposed over the weekend and getting that extra bit of theta. I'm trying to remember why what the answer to that was. One thing is that I just want to come in on Mondays and just deal with it on Mondays. I could do it on Fridays. The problem is, okay, yeah, now I remember. So you'll have an existing position on Friday, and you'll be pressured to make the opening trade right at the end. You'll have 5 minutes. You won't be able to relax and just do it whenever you want on Monday morning. You'll have an existing position on Friday that you'll be worried about, and you'll put on a new position. So you'll have to take the existing position off and put a new one on, and you won't let your uh, options expire all the way. And it just brings in a little more chaos to do it that way, if that makes sense. Okay, are there any more questions? Okay, well, remember, if the P&L is not real, what else are they trying to conceal?